Today on the final bar, choppy sideways action, a little rally though into the close, which is a different profile than what we've seen over the last couple of weeks. So certainly suggesting some accumulation going into the close with energy, communication services really pushing the market higher, consumer discretionary lagging behind. Today we're going to have my guest Ari Wald from Oppenheimer and the mystery chart. Ladies and gentlemen, this is the final bar. Hello, good afternoon, everyone. Thanks so much for joining us today here on the final bar on StockCharts TV. My name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks again for joining us. And a number of you have joined us since we started the show a couple weeks back, and we really appreciate it. As always, you can get to us at the final bar at StockCharts.com over email. Send any questions that you have, and we'll get to them as soon as we can. Interesting show today. We're going to talk about sort of this, reversal, upside reversal today in the markets with some, leadership from energy, communication services, laggardship from consumer discretionary, which is sort of a different profile, and especially the buying into the close, which I thought was really interesting. That's a different take. We're also going to look at a level up segment. That's where we upgrade our use of the product. I learned a new way to compare two different stocks I want to share with you and talk you through some ideas. Before we get to all that, I want to remind everyone I'll be speaking at the Traders Expo in Las Vegas. That's coming up just in a couple weeks on November 7th through 9th. It is in Las Vegas. It's an event really for active investors, especially traders. If you're looking at charts, there are a lot of really good discussions related to that. I'll be speaking Friday evening on a session called The 5 Modes of Mindful Traders, where we'll talk about how to get away from behavioral biases as much as you can. StockCharts.LasVegasTradersExpo.com. If you're interested in that, hope to see you there. So we're going to look at the charts. Again, the goal of this show on the final bar is to connect the short-term dynamics, the short-term price action with the long-term trends. A lot of times we get so caught up in the flickering ticks, so caught up in the short-term mean reversion, the short-term fluctuations, we forget to think about the long-term horizon, which is where most of us are trying to actually win the game. So let's try to connect to what we saw today with what we've seen up until today. So again, just orienting ourselves to the daily chart of the S&P, we've had this rally the last couple of weeks from the lows the first week in October. We're now in this supply area, what I call that area of resistance, where we failed a number of times before. So for whatever reason, there's a point here where the market gets heavy, where buyers are exhausted or where sellers come in, there's profit taking. We're right in that range. So yesterday we had this bearish engulfing pattern with an up day followed by a down day where the open close range engulfs the first day. Today we opened lower, which felt kind of normal to that, but then rallied up. We closed about in the middle of the previous day's bar. So, a nice accumulation for sure. Not too far before the close, about an hour before the close, we were down here in the lower end and then just sort of reversed higher and sort of rallied into that. So that picture where we have a rally into the close is actually a little different than what we've seen recently. We'll have to see if that is a sign of more institutional buying, accumulation, and betting on further upside. It'll be interesting to hear my guest Ari Wald a little later from Oppenheimer. He has some really interesting charts, sort of making the case for the next step in equities. So I'll let him explain sort of his take there. Let's look at the last 5 days to see how today fits into the most recent history. So here's that acceleration I was talking about in the last hour of trading. And again, most of the days have been more like yesterday, where you have this distribution in the last 30 minutes. So really a reversal. And again, that usually suggests some institutions sort of buying into the close. So we'll have to see again. Anytime I see a move like that, it's all about the follow through. It's all about what comes after that. So we'll have to see how we react tomorrow and beyond. Again, that bearish engulfing pattern, I still think still suggests some short-term weakness, but we'll have to see what comes next. Looking at the sectors, energy and communication services kind of were teasing each other in terms of which one would lead the way. Energy finished up on top, communication services right about the same. Number of names sort of leading the way in there. But, interesting to see energy at the top there. It's sort of a theme we're going to tease out here in a minute with charts like Brazil, Arch Coal. There's some names that actually, and some ETFs that actually have emerged with a couple of pretty strong days that actually should put it on your radar if it's not already. Consumer discretionary, notably at the bottom, that's from charts like Nike, which are coming out and weighing pretty heavily on it. So again, looking at the long-term trend, something like consumer discretionary is still holding up just fine. But if we look in particular at Nike footwear, the footwear group was down the most. Nike down over 3% today. So you can see again, up until today, kind of felt pretty good. We're approaching the overbought region. We become overbought, but overall we've broken above long-term resistance. Looks pretty good. And then today we've obviously come way back down into the middle of this range from the end of September, beginning of October. So again, we're sort of now entering this short-term support area. It's still in fine shape, and obviously over the long term, the chart has still been a pretty good performer on a price and a relative basis. One bar does not make the chart. It sort of fills in the next steps to it. But interesting to see a pullback in one of the charts that had been really, I would argue, one of the more leadership-oriented names than we've seen. A lot of other movements to sort of highlight. I would point out something like NASDAQ comes to mind. We talked about financials a lot yesterday, looking at the XLF, looking at other places. This group, sort of this investment services exchanges type of group, has been interesting. There are times over the last year where this group has been fantastic. Things like CME, CBOE, those kind of things. And then there are other times when the chart looks completely busted, and all of a sudden they get really heavy, really weak relative to others. And that was a period we had toward the end of last year where all of a sudden it felt like the charts were all underperforming. This has actually just started to rebound off this support range above 96, kind of coming up, and today a nice push higher. So the challenge with a lot of the names in financials, and this one is certainly no exception, is that we're entering this resistance level, right? So you've got 104 on something like NASDAQ. Looking at the broader XLF, we're sort of right at that same resistance level. A nice up move today, but again, we're right up against resistance here around 2850, 2870. So, again, if the other financials can continue to go stronger, we can push above the resistance here. That would be really, certainly a vote on the bullish side of the camp long term. But again, it remains to be seen whether or not we'll see that. I did mention Brazil, so I just wanted to bring up that chart. So there's an interesting phase here, right, where the commodities ETF, DBC, really good over the last couple days. That's reflected on commodity-oriented securities in Brazil. Certainly parallels pretty well to what you see with something like oil prices and energy. So you can see now we've had this little bit of a rotation now, established a higher low at the beginning of October. That's coming off the low end of August. And now back above the 200-day moving average, also the 50-day, and now breaking above the swing high, right, which is the resistance level from last month. So this rotation from more of a negative move below the 200-day, now establishing a higher low, now breaking above resistance, that kind of completes the transition from bearish to bullish phase. So, 2 strong days have now turned this into a chart that probably should be on your radar if it's not already, and breaking to new relative highs for the last couple months. So worth paying attention to that if you haven't already. All of those things that I just showed you, I came up with looking at the member dashboard. So if you're not using that part of StockCharts, I certainly encourage you to do so. In our next segment, it's called Level Up. What we talked about thinking of the show was just routinely come back to and revisit to using the platform StockCharts.com as more of a power user. Before we get to that, though, sorry, my producer just hit me on the head and reminded me I need to introduce the mystery chart. Thank you so much, Zach. The mystery chart. Can anyone guess what this chart is? It is not something we've looked at so far during the show, but it is something we've referred to many, many times recently. This is a U.S. traded security. That's all I will tell you. I've blanked out the tickers, and I'm looking at the price with moving averages, looking at the RSI, and looking at the relative strength versus the S&P 500 at the bottom. So the question is, what is this chart? If you have any guesses, put it in the chat room on the StockCharts TV window. We're going to gather those, and a little later in the show, I'll reveal what this is, why it's an important chart for you to pay attention to, and see if any of you were able to guess those tickers correctly. So let's get on to this next to the next segment called Level Up. So again, the goal is to level up your use of the product, learn from some of the power users. And I look at people like Arthur Hill, Tom Bowley, guys, Greg Schnell, people that whip around this platform so incredibly well because they've been using it so consistently for years. And I like to share some of the things I've picked up from them, and also some of you that have pointed out some really interesting ideas. So How do we compare multiple securities? It's a common question that I get, and I want to share with you just a couple ways that you can do it. So we have some really interesting comparative analytics that allow you to sort of break things down in a number of different ways. So the first thing I would point out to you, getting one example, is you can stack two charts together. We hinted at this in the Q&A session yesterday. So the way that you do that is just create a chart with the first ticker, and then instead of adding a second ticker, you go down to the bottom under indicators, select price, and put in the second ticker. You can do that with a bunch of different things, but this will actually stack the chart. So I find this is helpful if you want to look at two different price patterns and see if they're confirming or not confirming each other. This is a really good way to do it. So if you're looking at like a growth index and a value index, or the S&P and the NASDAQ, or the Dow Industrials, the Dow Transports, two different groups, whatever, and you want to just look at the relative movements. Are they both breaking to new highs or failing to do so? This is a really good way to do it. So create the first chart, and then just at the bottom, add an indicator called price, and you can do it that way. Now you can also stack charts on top of each other. You can overlay them. So the second type of chart I'll do, this is actually called a performance chart. It's part of the Sharp Charts window. And what you do, again, is create a chart with the first ticker. And then what you want to do here is create the type and say performance. It's at the bottom of the list. And once you call it a performance chart, all that's going to do is normalize it. So you're looking at percent returns over a period of time, and you can customize where you're starting that. Then at the bottom, add additional indicators called price-performance and put in the tickers there. And you can stack up a bunch of different things. So this is good if you want to look at the patterns sort of overlaid on each other and see how they're moving relative to one another. Similar to what we saw before, but just visually it can tell a different story and bring different things to light. And what I would suggest if you do this is to use things like colors and bolding things and minimizing things. You can use different tricks to make certain data series stand out more than others. And all you need to do is at the bottom, use some of the tools down here to sort of change the look and the feel of the different lines. But there are ways you can really illustrate a lot of different things relative to another, and even stack like 10 things on here and highlight one by just making it a bolder line to sort of tell that story. Now let's get into the really cool stuff that I've recently just learned up. So on the top, on the toolbar, if you type in two different tickers and separate them by the comma, this is going to easily give you sort of a relative performance chart. This is kind of a quick way to do that chart that I showed you before. And all it'll do is it'll allow you to just look at the two of them. It automatically creates a relative performance chart. You can then start to customize this, save it to a chart list, and do other things to it. But if you just want to see very quickly visually what are two things looking on top of each other, that's the way to do it. But the other thing I want to suggest you do is up here, normally when you type a ticker, it says Sharp Chart. If you switch that to Gallery View, you can go up here and then type the same two tickers or whatever two tickers you want. This will actually show you a gallery view for the two different securities at the same time. This is super, super impressive. So if you've not done the gallery view, it automatically has an intraday chart, a daily chart, a weekly chart, and then a point and figure chart. And it actually shows the first on the left and the second on the right. So now you can look back and forth. So here I can see Coke has just started to break above resistance. This is looking at the last couple days. I can see that Pepsi, on the other hand, has broken above its high for the last couple days. So they both rallied pretty well into the close. On the daily view, I can now see how these trends are related to one another. So I can see where they're at relative to key resistance levels. Also look at some of these indicators and see if I'm getting a clearer signal from one versus the other. So using the PPO, which is very similar to like the MACD indicator, recently giving a buy signal from Coke because it started to roll up a little bit. But with Pepsi, it's actually not quite giving that signal yet because of the way that the price has sold off of that high just above 140 a couple weeks ago. Then I can look at the weekly chart and start to compare the two of these together. And at the bottom, I'm looking at the relative performance. Here's Coke relative to the S&P. Here's Pepsi relative to the S&P. So what's neat about this is you can also do it with industry groups or other things like that. So let's say I want to look in here and look at home construction. I'm pulling these tickers, by the way, from the industry summary page. Whoops. I want to put it right here. So I do security number one, hit a column. I'm then going to go back to the this one, and I'm going to do, let's see, home improvement retailers. And we'll put these on here. So now what I'm going to be able to do is actually compare two different industry groups using that same gallery view. And now I can start to look at how these two groups of stocks are performing within consumer discretionary. I can see how home construction, with a lot of the home builders, really having a nice breakout and a nice consistent run over the last couple months, whereas something like home improvement retailers just starting to test upside resistance, just breaking out of sort of a longer base. You can customize all of these charts on here. And if you're not familiar, right at the top, you'll see this thing right here that says Learn How. All you need to do is create a chart style with these names on it, and that's what's going to show on your gallery view. So you can customize those with different indicators, with relative performance, with whatever you want. So again, the goal here is switch to gallery view, enter 2 tickers separated by a comma. Some really cool comparative analytics are opened up for you. That was a segment of Level Up. Again, we love to revisit the product and just sort of highlight what some of the power users are using StockCharts for. So I hope this was helpful. We're going to take a brief commercial break. We're going to be back with my friend Ari Wald from Oppenheimer. See you in a minute.
Today's market volatility provides savvy traders and active investors with an abundance of profitable opportunities. At the Traders Expo Las Vegas, November 7th through 9th, over 75 of the most respected traders in the world, including Dennis Gartman, Tom Sosnoff, Todd Gordon, and Tom DeMark, will explain how they're adapting their strategies and share the specific trading opportunities they've identified in equities, options, forex, futures, cryptocurrencies, and more. Claim your free pass to join them at tradersexpo.com.
Missed the live show? Want to rewatch a workshop? Tune into the StockCharts TV YouTube channel to catch up on the latest programming and content. All of our live shows, workshops, special guests, and more can be found there. Each category has its own playlist, so it's easy to locate. We even have chart school and creative strategy videos to help you become a better technical trader. Leave comments for our commentators, like your favorite videos, and don't forget to subscribe to our YouTube channel.
Hello, everyone. Welcome back to the Final Bar. This is Dave Keller at StockCharts.com. I want to welcome on my guest, Ari Wald from Oppenheimer, calling in from New York. Ari, thanks so much for joining the show. We really appreciate it.
Of course. Thank you, Dave, and congrats on the new show. It's really great.
I appreciate it, and I have to tell everyone. So I've known you for a number of years, and during my Fidelity days, I would say, and nothing against your peers in the industry, but there are a small subset of sell-side analysts coming through that sort of a must attend, that you'd want to pay attention to what you said, and you were certainly on that short list. So I'm really excited to hear what you're telling clients recently. And the first chart is the European stocks banks index. What are you seeing here?
That's right. Well, the lead-in is that we have the S&P 500 still stuck in a range, but we think the pieces are slowly coming together to what should be a breakout in the S&P, a more bullish 2020. And I think the key positive that I wanted to discuss today is that participation is slowly starting to broaden out globally, specifically in Europe, emerging markets, and the U.S. too. So let's start with that chart of the European banks, which has really been a critical risk-on area of the market in recent years. And we want to highlight that the industry is basing at decade-long support dating back to its 2009 low. Now, we're flagging that the current turn looks similar to the turns in 2012 and 2016, and specifically that each of these bases developed in 3 stages. First, there was an initial high-intensity low, which is the bang. Now, that's usually followed by a less intense low, which is the whimper, and each one was finalized with a snapback rally above the 200-day average. So we're making the case that December 2018 was the initial high-intensity low in Europe and for Europe banks. This was followed by a less intense low more recently in August, and now this month's rally above the 200-day average is confirming the reversal. And the assumption here is, very easy. We expect this to develop again as long as that 200-day is upheld. That's our stop level.
It's really interesting. And again, the parallels to what we're seeing now versus what we've seen in 2016, 2012, really clear on the chart. You can see the reaction off of support. So interesting bullish case. I like that. Now, the second chart you had was on emerging markets. What are you seeing here?
That's right. Not just Europe. We also have the iShares Emerging Markets ETF, ticker EEM, which has really been in the crosshairs of the U.S.-China trade war, also stabilizing at major support. So the first thing to note for EM is that the advance back in 2017 reversed a 10-year downtrend dating back to 2007. EM went on to peak in early 2018. It had a really textbook bear market that bottomed a year later and now has spent the entirety of 2019 building a base. So it still needs to complete the base with a higher high above the April peak at $45. But we see this potential and the opportunity for rotation, which would be another tailwind for the global bull market scenario.
That's really interesting. Now, your third chart I want to get to because it's leaning more a little into the U.S. But before we do that, it strikes me that the two things you've shown with European banks starting to look more attractive, or a compelling, long idea here, emerging markets starting to roll up and threatening to break above that swing high. I would assume many clients you're talking to would be sort of caught off guard with this sort of thing because we're kind of comfortable with the U.S. over the world and just forget about international markets. Is this a catalyst, or is this a signal that we should be paying more attention to non-U.S. versus U.S. at this point?
I think it's less of a relative call. I think what was just a narrowly led advance by the U.S. is now broadening out. I don't think the U.S. should be disregarded here, and that was the lead into the third chart. I think it's more so that you're filing on all cylinders. U.S., Europe, EM really makes for the bull case overall.
That's fantastic. Now, the third chart you sent deals specifically with breadth in the form of the value line index. What do you see here? Yeah,
so and to kind of hit on that point, that within the U.S., that in fact I think this is where U.S. breadth broadens as well. Here we're charting the value line geometric, which is an equally weighted composite of about 1,700 issues. It's more or less a gauge of what the median stock is doing. And the important signal to flag is that this breadth index is testing its major breakout above its 1998 peak. That was a secular breakout. So here again, more is needed. If we think in terms of the Russell 2000, which looks similar to the value line on a daily basis, we know we haven't had the breakout move in small caps yet. Mm-hmm. The level of breadth really can't be disputed, and it's currently unconfirmed, but it's the direction where we might see differently than others. While one with a bearish view would point to a lower level versus the peak reading from last September in terms of the Russell 2000, we're keying on the higher level versus the low reading from December, meaning we think directionally participation is positioned to broaden rather than contract, and the fact that it's carrying at such an important support level makes it all the more compelling.
That's great. We've talked about breadth a number of times on the show. We've never, I don't think that I remember, brought up the value line geometric as a way to illustrate it. That's really, really well done. Ari, 3 fantastic charts. I really appreciate you coming on and sharing those with us.
I appreciate you having me on, Dave. I always like to remind you that your signature is on my CMT certificate when you were the president back in 2011 when I got it. So thank you for that, for signing off on that. Yeah.
And very, very well deserved. Ari, good to talk to you. Thanks again for coming on, my friend.
Take care. Bye.
So ladies and gentlemen, that was Ari Wald from Oppenheimer, getting ready to go on Bloomberg TV. So we really appreciate him coming on our show just beforehand to share some charts with us. Have any of you guessed what the mystery chart is? I'm bringing it back up now. Let's see, a number of guesses. We have some very intuitive and in-tune guesses. Well done, emerging markets, and you're absolutely right. This is the EEM ETF. And the reason why this is interesting, of course, it helps us. I'm talking with Ari and we're looking at EM together. When you look at this chart, again, for me, and the reason why I asked him about people getting caught off guard with this, again, for me, talking with institutions, this is a trade that most people are not super on board with because we're so comfortable with the U.S. dominating. And if the U.S. is going to keep outperforming, that's kind of where you want to tilt. But as individual investors, there are a lot of opportunities outside of the names you're comfortable with. And I think something like EEM, if it continues to rotate higher, so now it's established the higher low, broken above the swing high from September, just threatening that today, nearing this trend line breakout, which takes us back to April and July. And look at how it's now flat on a relative basis relative to the U.S. Looking over the last year. It had been underperforming by 3-4% not too long ago as it sold off a lot more than the U.S. did. But look at how it's essentially gotten you the same return over the last year as the U.S. And now if it starts to rotate higher, it's a little earlier on in the trend. If that emerges and you start to see this participation outside the U.S. that Ari was showing you could be a compelling opportunity to sort of diversify a little bit and think for, look for opportunities away from the U.S., away from sort of the names that you're familiar with. So if you're not looking at EEM and some of the other emerging markets, I think it's a really healthy idea to do. I would tell you this, remember when you're looking at EEM, and I'm going back to the market summary page here. If you look at some of the international ETFs here, remember EEM actually combines a number of different things. So you have a big exposure to China. So if I remember right, probably a third of the EM index is China. I might be wrong on that, but I'm pretty sure it's something like that, which means it's a huge weight. So the U.S.-China relationships obviously are going to drive EM in a big way. And when you see China down, that's going to drag EM down as well. But just today, for example, you have Brazil up a pretty healthy amount while China's down. And so there are opportunities. There are nuggets within EM that might actually emerge really well. So Brazil, Russia, India, these are all components of emerging markets. They're all doing pretty well on a day when China is not. So, just a plain exposure to EEM is going to give you a lot of China and some other things. There could be some opportunities across there. So certainly get familiar with some of these international ETFs and some of the levers you can pull as an individual investor. There's a lot of markets we can get access to. I did make a note thinking about China. Someone had asked about the different China ETFs. There are a number of ETFs that can get you there. And so maybe in a later show, we'll spend a little time talking about some of the different China ETFs and strengths and weaknesses and performance relationships, just to make sure you're aware of it. So good guesses, everyone. I continue to grade the team final bar very, very highly. You guys are good guessers. So I will continue to ratchet up the complexity level. It is time to wrap up the show today with the 3 in 3. So as you know, at the end of every show, we like to hit on 3 charts. And again, hopefully you have seen these before. A lot of these we refer to regularly on the show. But if you haven't, these are the types of things I'd encourage you to stay on top of, because these are the types of charts I think that will help expose emerging themes and help you stay on top of the charts you need to. So the first one is offense versus defenses in consumer. This is consumer discretionary versus consumer staples, just a simple ratio of the two. We drew this line back here, sort of end of July when we rallied back up. Had a lower low in August and sort of this nice downtrend, really favoring staples over discretionary over the last 5 months now. Sort of put in a higher low at the first week in October, rallied back up, and all of a sudden it felt like it might be reversing, breaking above the swing high, breaking above the trend line. And now just in the last couple of days from the end of last week, sort of reversed back downward. And you saw today consumer discretionary was at the bottom of the sector movement list on today's price action. So, this ratio, in my opinion, thinking of long-term upside, stocks are holding up just fine as an overall index, but where are the opportunities going to come from? And I think, seeing this break out would make me feel much better about long-term upside for stocks, and we just haven't seen it yet. So it's telling you that, there's still a lot of bets on the defensive side of the ledger there. The second one is looking at growth versus value, and there are a lot of different ways to do this. A lot of people do the Russell Growth and Russell Value ETFs, which is totally fair as well. I like to look at the pure growth and pure value ETFs, which is RPG and RPV. And the quick version of that is a lot of stocks are actually double counted. They're considered both growth and value because they have both characteristics of sorts, like Microsoft is a classic example. This one actually classifies stocks as one or the other, so it's more of a clean cut of the two. And as you can see, this ratio came down very quickly in September, bounced back up at the beginning of October, and now again has gone to a new swing low. So this ratio is clearly favoring value over growth. And the reason why I bring that up is I think a lot of people are just in such a growth mindset, especially if the market holds up. Now the market is holding up, but with value being more in the leadership area. So if you're not screening for ideas in traditional value names, it might be really a good time to sort of do so. And then the third thing I wanted to bring up was Arch Coal, and it's not telling you it's a recommendation, go buy Arch today. Well, the idea is just to illustrate that there are a lot of stocks that are breaking out, a lot of stocks that are breaking down. This is an encouragement to screen for ideas. Something like Arch Coal is usually not on people's radar because it's not a company you're familiar with. It's not a space you spend a lot of time thinking of. You're thinking more maybe about consumer products or technology or other things. But things like coal and other spots within energy, it's not just oil. There's things like coal in here that over the last couple of days have actually broken above the 200-day above resistance. If names like this are starting to perform well, why not think of them as a potential opportunity? And I like how the relative strength is now broken to new 2-month highs today. That is the 3 and 3, and that is the show for today on The Final Bar. You can email us anytime, thefinalbar@stockcharts.com, or hit us on Twitter @FinalBarSCTV. If you've not checked out our YouTube channel, please do so. We have all our old shows there. For StockCharts.com in Redmond, Washington, this is Dave Keller. Have a great night.